In today's competitive business world, traditional accounting methods often don't provide the best guidance for decisions that actually improve profitability. Throughput accounting offers a different approach by focusing on how quickly a business can generate money through sales, rather than just cutting costs. This approach, developed within the theory of constraints framework by Dr. Eliyahu Goldratt, helps businesses identify bottlenecks that limit revenue, prioritize actions that increase throughput, align operations with overall strategic goals, and improve cash flow by turning inventory faster and using resources efficiently. It's especially useful in industries like manufacturing, services, and startups, where resources are limited and flexibility is key. The core of throughput accounting lies in three main measures: throughput, which is sales revenue minus direct material costs; investment, which includes money tied up in inventory and equipment; and operating expenses, which cover all other costs needed to run the business except for direct materials. This method shifts the focus from cost control to maximizing profit by understanding and managing these key metrics. To apply throughput accounting effectively, the first step is to identify the system's constraint, which is the resource or process that limits the overall output. Once this constraint is clear, we measure how much throughput each unit of the constrained resource generates by calculating throughput per unit of constraint time. Next, we evaluate decisions based on their impact on throughput, focusing on actions that increase throughput without causing a disproportionate rise in operating expenses or inventory. Finally, we monitor performance using specific TA metrics to track changes in throughput, inventory, and operating expenses, helping us assess improvements over time. To illustrate this, consider a factory with a specialized machine, the constraint, that operates 2,400 minutes per week producing two products. Product A sells for £120 with material costs of £40 and requires 30 minutes on the machine, while product B sells for £100 with £30 material costs and needs 15 minutes on the machine. The first step is to calculate throughput per unit by subtracting material costs from the selling price, which helps us understand the value each product adds relative to the constraint. This numerical example sets the stage for prioritizing which product should get more time on the constrained resource to maximize overall profitability. First, we calculate throughput per unit by subtracting material costs from the selling price, which gives us £80 for product A and £70 for product B. Next, we find throughput per constraint minute, which is the throughput divided by the time each product spends on the constraint. Product A takes 30 minutes on the constraint and generates £80 throughput, resulting in about £2.67 per minute. Product B takes only 15 minutes and generates PS 70 throughput, which is around £4.67 per minute, meaning product B is more efficient in terms of throughput per constraint minute. Assuming unlimited demand, the factory should focus on producing product B because it maximizes throughput. With 2,400 available constraint minutes per week, producing only product B allows for 160 units, generating £11,200 in throughput. In comparison, producing only product A results in 80 units and £6,400 throughput. Prioritizing product B provides the highest contribution to profitability given the constraint. Producing only product B results in £4,800 more throughput per week because, while product A has a higher throughput per unit, product B is more profitable when you consider the constraint. Traditional cost accounting might lead you to choose product A based on per unit profitability, but throughput accounting focuses on maximizing the overall system profit and correctly prioritizes product B. This approach has practical applications across industries. For instance, a furniture manufacturer found their CNC machine was the bottleneck, so they focused on high-margin items and outsourced lower-margin ones, boosting profitability without expanding capacity. Similarly, a SaaS company used this method to prioritize feature development that would drive customer upgrades and reduce churn, rather than dividing developer time evenly. A retail chain optimized shelf space by giving preference to products with higher throughput per square foot, leading to better inventory turnover and increased sales. Throughput accounting stands out by focusing on real profitability, simplifying decisions with clear metrics, identifying key constraints limiting growth, and supporting businesses to adapt flexibly in changing markets. Throughput accounting helps bring better alignment between daily operations and overall financial goals, making it easier to focus on what truly drives profitability. However, it does have some limitations. It may lack the detailed cost breakdowns needed for long-term planning, and shifting to this method can be challenging since teams used to traditional accounting might resist the change. It's also important to note that throughput accounting isn't compliant with standard financial reporting rules like GAAP, so it can't replace those formal reports. Additionally, for businesses with multiple products and complex environments, this approach might oversimplify the situation. Despite these drawbacks, throughput accounting provides a valuable perspective by highlighting constraints, prioritizing activities that maximize throughput, and helping to align resources more effectively. This focus can unlock hidden opportunities and support sustainable growth. For leaders who want a clearer way to connect strategy with everyday execution, throughput accounting offers a useful and practical tool to navigate complexity and improve decision-making.